Hello and good evening, and welcome to each one of you. Thank you all for joining us for our third session. I hope you all have been learning a lot in the first two sessions, and it has been informative. Welcome again for the third session. We're going to be looking at more on the practical aspect side of the investments and trading. So, today, the session is going to be on simplifying technical analysis for making smarter investment decisions. So let's just jump into what technical analysis is. And as we go forward in this session, if you all have any questions, please feel free to keep writing in the Q&A section. And I will try and answer all the questions as much as possible before the end of today's session. So let's dive forward towards what technical analysis is. And this is going to be exciting. I'm going to keep it as simple as possible. And everything that we do, the more simpler it is, the best way to do it is in the most simpler terms. So let's just dive right into it. Coming to what is there in the topics that I'll be covering for you today. One is understanding what technical analysis is. Second, once we understand how technical analysis is made, you will learn what are the different types of chart types that is available. So understanding different types of charts. Then once you understand what are the different types of charts, we look and identify for patterns that are formed on these charts. Now, these patterns help us to identify entry opportunities for investments or trades. Then we'll understand a couple of basic indicators that you can keep as part of your investment technical tool for you to understand how to make your decision every time you want to enter the markets or when you want to exit the markets. Then we'll also do a couple of sessions on the live trading platform so that it's more easier for you to understand how to place a specific opportunity, take advantage of it. But most importantly, we also will be learning the discipline of the risk reward ratio, which is more which is one of the most crucial aspect for investments and trading. So we will be diving into that as well at the end of the session. Now let's jump into what is technical analysis. Now there are two types of analysis that investors and traders do. Now, one is the fundamental analysis, and the other one is technical analysis. Just a very brief example of these two would be, let's say you're looking Tesla as a stock. You want to invest in Tesla as a company. Now, there are two types of views that you'll be looking at. Let's say you do a fundamental analysis. Under fundamental analysis, what all do you consider would be the financials of Tesla, how they have been progressing. You look at their profit and loss statements, and you look at their future prospects and the product line that they have in the future. Now, fundamentally, you believe, based on seeing all these numbers, all the products that they produce, to be a fundamentally strong company to be invested in. Now, once you do this analysis and you understand the company is strong in terms of their fundamentals and they're strong in terms of their future forecast, you would want to invest into this particular stock. But when do you invest into this particular stock? At what price is the best price to invest in this particular stock? Now, this is where technical analysis is going to help you understand what is a very good price or what is a very good entry level when you're investing into a fundamentally strong company or anything that is fundamentally strong in terms of, let's say, if you're doing commodities or if you're doing any other securities. So the main difference between fundamental analysis and technical analysis is fundamentals looks at the fundamentals, the finances, the prospect of the company, whereas technical analysis helps you identify what price and what level would be an ideal level to enter. Now let me give you a simple example on technical analysis. How a technical analysis formed. Now, usually, technical analysis is based on statistics of the previous price movement of that particular product or the instrument or the security. Now, we look at how the particular price behavior has been in the past, depending on when the markets have been going up, when the markets have dropped. Now, to give you an example, let's say you look at a historical price movement of a stock XYZ, and you notice that every time the stock, now we understand the stock is fundamentally strong, but you also notice, although the stock is strong, a good company to buy, you would still see drops in the market. You see the stock probably after going up by 20-30%, it gives a drop of 5 to 8% before it continues its upward swing again. So now these drops are where you get as an investment or an opportunity to get into the stock. Now, how do we know if a 5% drop is a good level to buy, or if a 8% drop is a good level to buy? Is by looking at its history. Now, let's say we have the history of this stock for the last 10 years, and you see a price action behavior that every time the stock has been booming, and then when the stock retrace, which when it gives a dip down in the market, on an average, it has always dropped down probably between 5 to 8%. Now, is this the ideal scenario over all the particular instruments? No, it is not. But I'm just giving you as an example in terms of what are the tools that we can use to identify opportunities. Now, in this stock, we see it drops between 5 to 8%. If there is a geopolitical tension, you see the stock dropping all the way even as close to 20%. Now, these are few metrics that you can keep in mind while you're entering the stock. Before you enter, you would look at if there is any geopolitical tension, fundamentally, if there is anything that is happening in the company, if everything looks good and you find the stock retracing by 8%, now here is one of the metric that you could use to consider to invest into the stock. Now, again, this is just an example. Let's look at few other technical tools that will help us validate these kind of entry points by giving 2 to 3 other signals before we take a decision into the trade. Now, why use technical analysis? Like I just mentioned, the entry point, the stock that we fundamentally believe is strong, when the price is falling, is what we will look at entering. Let's look at a chart over here. Now, this is SPX 500. For those of you who are very new to the market, SPX 500 is the top 500 stocks in one single basket. So the performance of the top 500 stocks of US is the reflection of what you see in this particular chart. Now, again, this particular buy that I have put over here is just for demonstration purpose. Now, based on certain parameters, like let's say, for example, when I give you an example of a drop of 5 to 8%, would be one of the parameter for considering investing into this particular index. uh, at the same time, if we have 2 to 3 other signals that gives us the same indication, it would give us a much more confidence while entering. So you look for a buying opportunity. Now, this is what technical analysis helps us. But along with buying, we also need to understand, it is very, very crucial to understand when to exit. Now, yes, probably in this case, we would have bought it at a very low price, but at what levels do we exit? Now, this is where technical analysis will help us again to understand what price is the best price to exit, or how long can we expect the prices to continue moving upside before it gives you a retracement. Again, this is just an example for you all to see over here. In this case, let's say there are very technical tools that has helped us identify that the price could give a bigger drop here. You could probably exit your positions and look at re-entering when the prices drop back down. Now, let's look at understanding the different types of charts that is there. Lot of technical analysts are also known as chartists because they look at charts, they look at price trends, they look at patterns to identify opportunities in the market. Now, when you're looking at identifying opportunities, it is not restricted only to stocks. You can use the same technical charting on any products. You can use it on commodities, you can use it on equities, you can use it on indices, etc. So there is no limitation in terms of technical analysis based on different products. Now, let's look at two main charts that a lot of people look at. Mostly, candlestick charts are the charts that most of the technical analysts use today. At the same time, there is a great importance even for line charts, which I will show you in a couple of examples as I move forward. Line chart is very easy to understand, interpret, understand the pattern, and also identify crucial support and resistance points. At the same time, candlestick patterns will give you a much more in-depth understanding of what is happening in the price movement of a particular instrument. Let's look at how a line chart would look. This is basically a line chart. This is for the stock Apple. We see the price at this point of time has closed at 176. We are looking at a weekly time frame. One more very important point that I would like to make is when you're doing technical analysis and when you're doing charting, it is very, very crucial to understand one, what time frame are we looking at. So every time we choose a time frame, it has a specific meaning to it. I'll give you an example. Let's say if you're an investor and you would want to invest, let's say for next 1 year to 2 years, you would always look at a weekly chart or a monthly chart because it gives you a much broader picture. At the same time, let's say you are someone who's trying to take advantage of a daily movement, right? Now, for a daily movement, if I'm looking at a weekly chart, it is not going to give me too much of a clarity as to what I can expect for the prices to move for this particular day, because it's giving us a very longer time frame horizon image over here. So you would always look at a 30-minute chart, or you would always look at a 1 hour to 4 hour chart, depending on what how frequently you would like to take the opportunity. Now, in this case, on the weekly chart, you see the line chart. Now, this line is a dot basically of every day's closing price. As of yesterday, it closed at 176. So, as of next week, wherever the price closes, let's say the price closes at 180, you will see the line chart close at 180 and so on. Now, like I mentioned, candlesticks has the same pattern, but it has much more detailed in depth. So each of these candles represents 1 week's movement, right? 1 week worth of movement in each of these candlesticks. We will go into how the candlesticks are formed. What does a green candle signify? What does a red candle signify? And I'm sure you would also see a lot of wicks in this candle, which I will explain to you in the next slide. Now, let's just compare line chart. Okay, you see the prices moving up and currently at 176. Let's look at candlestick chart, 176, and the price movement is the same. So these are just two different charting techniques, except that line chart has a much more cleaner view, whereas a candlestick chart has much more detailed view of each week present in this particular chart. Let's dive into what are these candlesticks. Traders use this candlestick to determine possible price movement. Yes, they also use to understand where the price had opened, where the price has closed. If you remember me mentioning, when I'm looking at a line chart, I'm just looking at every day's closing price, whereas a candlestick will show me in that week. Since I was looking at a weekly chart, it'll show me beginning of the week, where did the price open and where did the price close. If the price opened at a lower price, let's take Apple for example. Right now it is at 176. Let's say this week Apple opened at 176 and it closed at 180. So because the price closed above where it opened, you will see a green candle body forming. Now the green and the red body candle represents the body of the candle. Now the wick that you see over here, some would also call it a hairline. In this case, since we are referring it to a candle, so hence we refer it to as a wick. The wick is during the course of the week, we would have seen the prices open at 176 and probably it dropped down to 173 before it moved back up and it made a high of, let's say, 182 and it closed at 180. Now, the wick on both the extreme signifies how high the price went or how low the price went during that week's time frame before it closed, right? If anyone has any questions, please do let me know. I think some of you all are asking where can you find fundamental details for the US based stocks. There are a lot of websites. I will put up a couple of websites on the chat before we end the session. For fundamentals of the companies, you can also go to the company's website and see their review their financials. You could use companies like Bloomberg to get their financials to understand how the company is doing when it comes to their financials. Moving forward, I hope any questions on candlesticks, please feel free to ask me. You also would see different types of candles. Not all the candle is going to open and close with a very big body. You would also see some candles probably when the price opened at 176, probably it closes at 177. Hardly a dollar move. Hence, the size of the candle is determined by the price movement in that particular time frame. Few key things that keep in mind as we go forward. One is the time frame that you're looking at the chart is significant to understanding the opportunity and also the objective of why we are taking. To give you again an example, let's say if I'm looking at a monthly time frame chart, my objective is to try and take advantage of the market's movement in the next 1 to 2 years. It could go even beyond that. But let's say if I'm looking at a time frame of a 1 hour chart, now I'm looking at taking advantage of the price movement, let's say next 4 hours to maximum 8 hours during the day. So the time frame of the chart plays a significant role in terms of the opportunity, at the same time in terms of the objective that you have for yourself. Let's look at a couple of candle patterns that occur. Now, like I mentioned, each candlestick represents the time frame that you're looking at. So if you're looking at a 1 minute time frame, each of these candles actually represents 1 minute. If you're looking at a 1 month time frame, each of this candle will represent 1 month. We'll do this practically as well so that for those of you who are very new to technical analysis, get a hold of how the candlestick pattern works. I will show a couple of live examples on a very short time frame for you to understand how the candles are formed as well. Now, in this case, do candles have patterns that can signal as entry opportunity? Yes, there are a lot of candle patterns that form that give you signals. But again, a single candle pattern does not have to be relied upon 100%. We need to look at a lot of things. We should always look at technicals in conjunction with the fundamentals. Although you're doing a short term trade, we need to understand fundamentally what is happening today for this particular stock or commodity. Although we have a pattern that is indicating the prices to go up, we should make sure that we are also aware that there is no news that is fundamentally pulling the stocks down. At the same time, let's say we identify these patterns and we can use other technical tools to give a double or triple signal before you take a decision on the opportunity. Now this is an inverted hammer, obvious name for it because it looks like a hammer that has been inverted. This is a hanging man, unfortunately not a very good name for it, but yes, it looks like a hanging man over here. There's another pattern as an example that I want to show. Again, these patterns are not limited to this just 2 or 3. There are multiple candlestick patterns, but these are just for examples. Now, every time you see two similar candlesticks forming right next to each other with the body has one is on the negative side, one is on the positive side, but at the same time you see the wick from the bottom and not on the other side. These are known as tweezer bottoms. Basically, you see buyers dominating over here. So initially, the sellers were dominating, so hence the prices keep dropping. And eventually, once the second candle has been formed, which is equivalent to the previous one, you see a tweezer bottom forming here, and you can expect the prices to move back up. Now, again, we should be using this in conjunction with other technical indicators and not in isolation of using these candle patterns alone. Let's move forward to looking at the next very crucial and important aspect of technical analysis. Now, this is one of the most foundational tool that pretty much every advanced technical analyst also use. Whether they make it as simple as this or as complex as it could sound, ultimately everyone is looking for a good level to buy, and hence you call it a support. You see the prices dropping back down, and the when the prices bounces back up, it is taking support on a certain level for on a certain condition. Now, in this case, you could see the prices going up and dropping. So every crucial point where the prices do not penetrate through initially or a couple of times, you could call that the resistance line. Basically, the prices are not able to move beyond a certain point or a certain percentage. But at the same time, you see every time the market drops to a certain price level, you would see it bounce back up, and this is known as the support level. Now, keep in mind the second thing that we'll be looking at. One is the time frame that we're looking at. That is the first point to keep in mind. Second, now very crucial, which is more fundamental in terms of technical analysis, is your support and resistance. Okay, we'll be using support and resistance, the terminology a lot. Let's look at couple of examples over here. Trade the bounce. So buy when the price falls towards support. Now, how do you identify these supports? I will show you a couple of examples on that. Sell when the prices rise towards resistance. Trade the break. There is another way to do it is once it breaks above the resistance, you can actually get into a trade because now it has broken above a certain level and we are expecting it to move forward. Let's look at a couple of examples on support and resistance. Now, this is again US 500. I'm looking at a time frame of a 4 hours. So that means each, in this case, I'm looking at a line chart. So basically, every dot is the closing price of every 4 hours historically. Right now, we are looking at the price moving upward. So you see the support. Now, how do we draw a support line? Is when you see the prices moving linear or sometimes even horizontal, you can connect all the bottoms of the price. So once you connect about three bottoms in the price, then it becomes a strong support. So in this case, we see this was the first one. Obviously, we would not know the second one would be a support until the third one formed. In fact, there was one here. This would have been the second one. This would have been the third one. So now we see supports forming in. Now, this line could be extended into the future. So technically, I can evaluate how long this particular price movement is going to stay within this particular range, moving on an uptrend. Now, you can measure your support and resistance when the market is moving in a trend, or you can also look at support and resistance when the market is going sideways. Now, at the bottom, we have an indicator which is an oscillator. Now, this particular indicator shows you when the market is overbought, meaning the price is highly overvalued for a 4 hour time frame. At the same time, every time the prices are at the lower end, it indicates the prices has dropped, it has been oversold, hence the buyers could get back into it. We'll get back into this chart on the live example and look at how the overbought and oversold positions can help us again identify opportunities for entry. I have a couple of questions. Just give me a minute. Let me just go through it. Okay, that's a lot of questions. Okay, uh, it's a lot of questions. I will try and cover these questions as I go forward. What is the best time frame for day trade? Again, comes down to your objective. But this question I would answer when I'm showing you or demonstrating a live demonstration on the live chart. Is the candlestick for a day or a week, or could be anything that we decide? Again, this you will be getting a much more clarity when I show you the different time frames and how different time frames can be used, and what kind of objective does a investor or a trader have when they're looking at these time frames. We will do it with some more examples. I will continue the session and I will also try and answer the remaining questions. Now, plotting support and resistance, like I mentioned, one, two, three. Whenever you see 3 points, again on a horizontal basis, or even if it's in a trending market, as long as you find a linear or horizontal lines that you could draw on the charts, these becomes your support and resistance. Now again, a support and resistance is only confirmed when the price action has taken resistance at least 2 or 3 times. In this case, let's look at SPX. This is an older chart. When the prices of SPX moved higher, it took resistance at this level and it dropped. And because this is the first time it happened, I cannot conclude that this is a resistance level. But when it happens for the second time, now we can consider that this could be a resistance point. And when it happens for the third point, now it gives a good confirmation that this price at 4140 is a crucial resistance point. Now, a breakout above this is where you get an opportunity for you to get into the markets because the prices could continue moving higher once a breakout happens. Now, a resistance is more of a psychological barrier. A lot of people, when they're investing, they're looking at a certain price and they're exiting at a certain price, right? So when it goes beyond that price where you've seen a resistance, now you see there is more demand for that particular stock or the instrument, and hence more buyers are willing to pay a price which now has broken the resistance. So people are willing to pay a higher price, and hence you see the prices moving up as the demand starts increasing and more people get into it, the prices move up. So this is entry on breakouts. Whereas people can look at supports on the lower level. Every time it has come down to 4128, you see the prices pretty much has bounced back from here. Now these are levels where you could trade in a range. You buy it at support, you exit at resistance. Let's look at different support and resistance. Now, these are known as trend lines. Although it is support or resistance that you can see over here, you can see this particular price moving upward, but it's taking support every time it drops back below. It is taking support at a specific price. Now, why do the trend lines happen to appear in a chart? Is because every time the market comes back down, no one is looking at entering at the initial entry point of where it could have been. They are always trying to look at getting a good discount in the price before it bounces back up, and hence the buyers start coming in earlier and the prices keep moving higher and higher. So your supports are not always going to be lower at horizontal line. It could always be on a trending line. So hence these are known as trend lines. But again, keep in mind, trend lines will also help you identify your support and resistance. In this particular example, first support, second support, third support, and this is when I'm going to draw my line and look at the future. Now, in the future, assuming that this price action has not happened yet, every time it came back down to these levels, you would look at buying it, and every time it goes back up, now there you could draw a resistance line on above on top of this. That would be your take profit. Again, uptrend will have higher lows. When the prices drop, the price will make a higher low compared to the previous low, right? These are known as higher lows. And when it is a downtrend, you will see the prices making lower lows, and that is and lower highs as well. When it is a sideways trend, this is also known as a consolidation phase. The prices pretty much move in a range, which could be a very ideal scenario for traders to take advantage of. But again, it would not last long. So while it lasts, it's a good opportunity to take. Now, could a range like this appear even on upward trend? Yes, that is what we had seen over here. Now we see the price ranging higher, but although it is ranging higher, it is still trading within a particular range. This is known as a channel in technical analysis. So there are a lot of channels that a stock or a security could trade in, and a lot of technical analysis wait for a channel breakout. Let's say if a channel breakout happens on the upper end, now this is another buying opportunity. At the same time, you could buy and sell within the channel at the same time. A channel breakdown would mean the prices could drop drastically, because now it has gone beyond your support line. There is no longer support. Everyone is looking to sell off, and hence you would see a drop. And this is where you would want to exit your trade and wait for the next opportunity. Now, moving forward from trend lines, now we come to the patterns. Now, let me just go and try and answer a couple of questions. I think a lot more questions have come. Someone has told there's no audio. I hope everyone can hear me. Can you hear me? Please just drop in a message in the Q&A. Okay, I've got a couple of responses that you can hear me. I'll just wait for a couple more responses if you can, if you, all of you all can hear me, please. Okay, okay. Thank you. Thank you. I'll just try and answer a couple of questions. How many support and resistance lines are required so as to not to make charts complicated? Very good question. I will again, while I'm showing the live chart, I will show you how to make your support and resistance very simple, and how to draw it and make it more easier for you to comprehend. You could have a lot of support and resistance. One point that since this question came up is all the patterns that you see when you look at something on a weekly time frame. It has a specific pattern that is running in the chart. But let's say on the same time, on the same chart, if you go into a daily chart, now, this daily movement is within the weekly time frame. So these are known as fractals. Now, fractals are patterns that occur within a pattern. These are known as fractals. So depending on what is your objective, then we should be looking at those time frames to add your support or resistance. Now, if I add a support resistance on a monthly chart, on a weekly chart, on a daily chart, and a 30-minute chart, then it could our support and resistance could pretty much go to unlimited number of lines. We can always restrict that, although using a higher time frame along with a shorter time frame also is wise in certain cases, which again I will show you in the example. Few other questions. In the live chart, there is buy and sell at the end of each candle. What would this mean? Can you please rephrase this question to me? In the live chart, there is buy and sell at the end of each candle. What would this mean? I'm guessing you were referring to one of my slide. Let me try and go back. Buy and sell, buy and sell. I do not see buy and sell. If you can just rephrase that question for me, I'll try and answer that question. Sorry, I could not get the entire understanding of that question. Uh, in the meanwhile, let's move forward to the chart patterns. Now we have understood support and resistance, right? Now support and resistance can happen when the market is moving sideways. Support and resistance can occur when the market is moving horizontally. If when the markets are moving in a trending basis, whether they're trending on the upward trend or a downward trend, we still identify the support and resistance. Now, drawing the support and resistance, you identify patterns in the market. Now, these patterns might sound very silly for someone who's very new, but ideally, these are patterns that do form in the market based on demand and supply. And more importantly, it is the investor psychology that is there, which is imprinted into the overall charts. So every time you see a price action, it is based on demand and supply, right? So these patterns do occur more often than what you could imagine. If you're very new, if you're already intermediate or an expert in technical analysis, I'm sure you would have seen a lot of these patterns. Now let's try and identify these patterns while we are doing the live demonstration as well on a shorter time frame, because on a shorter time frame we'll see the patterns occurring much more faster. Now I'm not going to go through each of these patterns, but let's look at a couple of them. Now, this is an ascending triangle. In this case, you see the price. The red line represents the price movement of the line chart. The price has been moving higher, but not higher than the previous high. So now you see a flat straight line over here and then ascending line from the bottom. Now this is known as an ascending triangle. Obviously, for the image that it shows once you draw the patterns here. Now, how does an ascending triangle help, or how does it form? Well, first, you see the market actually coming up, and then it goes into a consolidation phase. Consolidation phase is the phase where buyers and sellers are consolidating. Buyers are buying in and exiting at a specific price, but you will see the buyers are dominating because every time the price comes back down, you see the buyers pushing the prices back up. And hence, every time you see a breakout that happens on an ascending triangle, is a opportunity for us to enter. There are two ways that you can enter: as soon as it breaks, or it breaks and when it comes back and retests the same which was the resistance earlier. This is where you enter, and it becomes more easier to keep a stop loss below the ascending triangle. Now you identified your entry point, you identify your exit if it goes against you, and your profit will basically be as long as this gap that you see over here. Let's say this range was roughly about 2% or 3%. Now, after you enter, after this breakout, you can expect the prices to move up by 2 to 3%. And that is where your take profit or your target is going to be on this particular trade. Now, coming to head and shoulder, again, a very popular pattern that appears on the charts. Now, all of these patterns can be identified very easily on a line chart. Although you can use candlesticks to identify these patterns, but a line chart would give you a much more cleaner picture when you're trying to identify these patterns. Um, Takeaways for today is keep in mind the triangle pattern. Try and identify few triangle patterns for yourself. I think all of you all will receive a demo account. Use the demo account. Try to identify a triangle pattern. Head and shoulder pattern is a little more complex to identify, but visually you should be able to identify a head and shoulder very easily. I will show you one example on the live chart for head and shoulder. Now this is known as a cup and handle, meaning the prices has been trading on a up and down movement, but it's create a more of a cup here, and then a smaller cup again, hence because it looks like a cup, it's known as a cup and handle. Once the breakout happens above the neckline over here or above the cup is where you enter the trade, similarly to what we did over here at ascending triangle. Now there are more examples in terms of double bottom, triple bottom. Triple bottom gives you triple confirmation that it can go up. Now, where else did we see a triple bottom? We would see it over here. You see one, two, triple bottom. So this is where you could enter the trade. Of course, we need to keep a stop loss below. Now let's assume the target is the resistance. So we enter at the triple bottom. Let's say the resistance is 5% higher. So you buy it at triple bottom, you keep a 5% take profit, but we also keep a 2.5% stop loss. So in the case where the price breaks below and continues going down, your risk is limited to the stop loss that you have entered. Now, one more point that I would put as a reminder: in technical analysis, irrespective of how good the pattern would look, how well the pattern has performed, or how well a technical tool has given you a 95% or 80% hit ratio, uh, we should always make sure the discipline of risk management is there. irrespective of our conviction and our past experience. Because at any point in time, a technical analysis could fail if there is a news, if there is a sudden news that comes out, which can change the entire scenario of the market, especially when you're doing a shorter time frame trade. Now, when you're doing a very longer time frame trade, then all the news would always be discounted because the price action we are looking for, let's say in the next 1 year or 2 years, is much more bigger than what we are looking to take advantage of on a shorter time frame. Moving forward, one of the chart pattern again similar to a triangle over here, we have a rectangular, which is also known as a bull flag. It's known as a flag, meaning it looks like a flag when you draw it. There is a long pole over here. Now, a bull flag again, the market was moving, and you see a sudden rush of buyers buying into the market, and it goes into again a consolidation phase. Consolidation, as in now the consolidation is taking place over here. Of course, the buyers are still in control. Once the breakout happens, in this, we do not trade on the supports, we wait for a breakout because the trend is slowly looking like the trend is reversing, but a trend would reverse only if it breaks below this particular point. But in this case, to be more on the cautious side, it is always better to take a trade based on a breakout rather than support because of the trend. Now let's look at the next pattern, which is the head and shoulder. Now we looked at the head and shoulder over here. Okay, why is it called a head and shoulder? You see the price action move, the prices came up, drop back down to a certain level. Prices go way higher than the previous time and again comes back to a similar level, takes support. Again, when you look at these levels, it does not have to be exactly at the same price. Let's say the price went from 10 to 25, drops to 20. From 20 it went to 35, drops to, it can drop to 22, and then goes back up to 25 and drops to maybe 19. So there are going to be slight variations in the price. It does not have to be exact, but more or less the range between 19 and 20 is the support. Now, head and shoulders, reason being it looks, these are the two shoulders and this is the head, hence the name head and shoulder. Now you will also see a reverse head and shoulder in this example that you see here. Now, in a reverse head and shoulder, the markets have been dropping, right? And then a pullback occurs to a certain point. Then market continues to drop. Again, the pullback occurs to a certain point. And the third time, if the market again takes support as same or almost close to the same level as the previous shoulder, now you identified it as a head and shoulder. Now, when do we enter a head and shoulder? Once the neckline breaks. Again, the entries when you're using support and resistance becomes very, very easy to identify when you're using your support and resistance. Again, do not use support and resistance in isolation. Please make sure that fundamentals are in conjunction with the technical analysis. One. Second, also make sure that you use other technical tools to give you a double confirmation when you're entering. Third most important thing, let's say you did use support and resistance for your entry along with in conjunction with all the other analysis. Stop loss should always be a priority, or your risk management should always be a priority, irrespective of how strong the signal is. Moving forward, let me just come back to the questions. What is the difference between scalping and intraday? Scalping is basically you're trying to scalp the price movement that is happening on a very high frequency, especially when there is a specific news that is going to come out or is come out, and based on the news, you want to take advantage of the price movement that could be considered as a scalping. Intraday would be something whereas you identify that the markets move a certain percentage on a daily basis, like S&P 500 moves about 1.5 to 2% on a daily basis. Now you want to take advantage of that particular move in the day basis, within the day. So that could be defined as an intraday trade. More or less, both of them are short-term trading. Would should be dealt with a lot of caution because the risk increases every time, whether you're doing scalping or intraday, especially if there is no risk management in place. Do wicks and tails form part of support and resistance? Yes, they could be considered for support and resistance because the price action is still valid. Let's say every time the price move to a certain level, although it is formed a wick, that particular price happening 2 to 3 times would be considered as a support and resistance. Now, a closing price or a opening price also is considered more stronger. Reason being, everyone by the end of the day or by the open have settled for that particular price. So it becomes a little more stronger in terms of support and resistance. But nevertheless, please do consider both while you're doing analysis. And if you're using your line chart, it does not consider the VIX. It considers only the closing prices. So you can draw your support resistance on your closing prices first and then shift into a bar chart or a candlestick chart to look at the VIX and probably have another level of support and resistance for that. How do we ascertain the price will go up or down in an ascending triangle? So the entry would be only when it breaks up or down. So let's look at the ascending triangle over here, right? This is an ascending triangle. Now, how do you come to a conclusion whether it will go up or down? Very simple. Now, it's an ascending triangle, meaning it is an uptrend. So something that is happening on an uptrend. Now, when there is an uptrend, you will always see the buyers dominating because whenever the prices are dropping back down, the buyers are not waiting for it to come down lower. They're buying it back much earlier than that. So hence it is ascending. Resistance, once it breaks above this, we can conclude that the buyers will overpower the sellers and hence the prices move up. So hence ascending triangle is known as a continuation bullish candle. So usually what happens is when the price moves up, in this case, let's look at this example. When the price moves up, there's a phase of consolidation. During this consolidation, there are a lot of patterns that can form a descending triangle or a bull flag or a pennant or an ascending. So each of them have a significance to it, but most likely all of them come under consolidation where once the, let's say the price had a huge move, it takes a breather, and once it breaks above again, now people are back into buying it more aggressively, and hence the price starts moving back up. I hope that answered your question. I'll come back. There are a lot of questions I will need to cover more, so I'll just come back to the questions. All right, now this is again S&P 500, the top 500 stocks of US, which is put into one basket. It's also known as index. S&P 500 is the benchmark to which all the fund managers look to beat in the market. Now, S&P 500 on a monthly time frame, again emphasizing on the time frame, we see over here has, this is 2022. That means each of these price actions has happened on a monthly basis. Now we see over here the prices drop, right, and it bounces back up, takes resistance, drops again lower, takes resistance and drops again to this point on the left shoulder. Now, why I've stopped my green line over here is to understand. Now, when this particular, when the 1, 2, and 3 point happened, I still do not know whether it's a head and shoulder. But I know it is a head and shoulder once the 5 happens and then it moves back towards the neckline. Now, this is where I identified this as a head and shoulder. Now, once this has been identified, we take a trade once the breakout has happened. Now, in this case, the breakout happened above the neckline. We take a buy here. Of course, we keep a stop loss. Now, how do I measure how high can the price go? It depends on the length of this head over here. From the neckline to the lowest point of the head is, let's say in this case, about 10 or 20%. Now, after you entered at the neckline, or if you've entered above the neckline, let's assume we missed this entry point and we have entered higher. Still, we need to consider 20% from the neckline and above, right? So that will be your ideal target. Now, if we are expecting a 20% move or a 10% move on the upside, we always make sure that we keep a stop loss of 5%. Now, this is when it comes to trading. Now, if you're looking at investing, you are looking at a longer time frame, so you would want to invest in such a way that in case if it comes back down, there are two options that you would probably want to buy more because you're investing in the top 500 stocks of US. But let's say if your objective was a short term trade, then it is always better to exit and look for the next opportunity. Okay, I think we'll have to run through a little more faster now. Relative strength index. Now, one more indicator, which is an oscillator, which I showed you earlier. Every time it goes above a certain point, it is overbought. Every time it goes below a certain point, it is oversold. Now, I'll not get into the calculation of the RSI, it will take time. But let's just understand how RSI works and why it was created. Now, RSI is an oscillator. So, RSI oscillates between 0 to 100%. So, it goes up, comes down, goes up, comes down. Now, every time we different technical analysts have different criterias. Some of them could put 70% as their criteria for overbought region, and some of them could put 80% as their overbought region. Now, it depends on technical analyst to technical analyst, depends on what time frame they're looking at and what analysis they're doing. But how it works comes down to every time the prices at overbought region, we could expect the prices to start dropping, and vice versa. Every time it has gone to an oversold area, that means the sellers are going to get exhausted and eventually the buyers are going to take control. Now, to keep in mind the fundamentals in conjunction, why would anyone buy at this price? There are a lot of factors. One is it has given a significant drop. Now, if this significant drop has been the same repetition previously, when you look at S&P 500, that could be one of the factor. Second, your technical indicator is giving you oversold territory. That means a lot of buyers would be interested in buying this particular index because it's given a discount in the market. And in terms of fundamentals, again, you're investing in the top 500 stocks. Now, along with this, if you go back in history, you could probably see support and resistance to add more to your buying. But again, very this example is just to understand the overbought and oversold. Let's look at okay, here we have another example which is very squeezed in. I will show this on the live chart soon. ATR, the last point that we'll be discussing for today. ATR means average true range. Very simple. Average true range is similar to, not similar, sorry. RSI is an oscillator, but what ATR tells us in a given time frame, that is in this case, I'm looking at Apple, in a week, ATR tells me how many dollars can it move. That is the average true range. Now, it does not give me the direction of the move. Okay, please note, ATR does not give you direction. It only tells you how many dollars Apple can move. Now, I understand Apple can move $7 in a single week. Now, let's look at this particular example, which is very interesting here. You see the prices is taking support. Earlier, it was the resistance, right? This level was resistance. It breaks above resistance, again comes back towards support, breaks above resistance, again comes back towards support, and now it is again breaking above the resistance. So if I have to buy Apple today, I would buy it today. But now the question is, where do I sell it? Or because I'm looking at a weekly time frame, I might be looking at, let's say, a week or 2 weeks or 2 months for me to get my results. Now, for my objective is for Apple to move back up based on technical analysis. Fundamentally, we all know Apple is a strong company. Now, let's say Apple goes back up. Now, looking at a weekly time frame, or sorry, a weekly movement, I know that Apple can move about $7 a week. So that means, let's say by next week, if Apple moves $7, I would be happy with my returns. $7 move on Apple is a good return. But let's assume that we want to continue our take profit. You can use the resistance as your take profit. Nevertheless, let's say there was no resistance and you want to understand how many dollars you can expect per week on Apple. You know that is $7. Let's say in 2 3 weeks we can expect a $14 move as well, and that could be your target. So ATR helps you identify how many dollars it can move. Most users would use ATR to identify take profit, which is double the ATR, and keep the average movement of $7 as your stop loss. So worst case scenario, Apple drops $7, you're out of the trade. And let's say Apple continues moving up because it has taken support, it goes up by 14 or $21, you exit the trade. Now, this is where ATR comes into use. Now, let's look at the live chart. In the meanwhile, let me try and what will be the stop loss for Head and Shoulder? Good question. I will be covering that right now. Can you provide some information about indicators? Yes, we can. What I'm doing today is taking you through a very basic foundational understanding of technical analysis. Now, these are foundations, like I mentioned, that support and resistance, these are used even with advanced technical tools like Fibonacci. You'll use any other technical indicators. It all comes back down to which price should I buy, where is the good support level for me to buy a particular instrument. um, if stop loss is so important, why most brokers who manage the account never give it? Uh, we have stop loss. We have take profit. Now, in terms of, let's say, risk appetite, in terms of, so every individual, every investor, every trader has their objective in mind. Now, that's why I kept repeating in terms of the time frame. Now, the time frame that you're looking at, let's say you're looking at a 30-minute time frame, and on a 30-minute time frame, an ideal objective would be to get the result of your price action in the next 1 2 or maximum 4 hours, right? Now, let's say in the 4 hours, this particular pattern or this particular signal that you have identified did not work out. There are two conditions: one, you have your stop loss in place; second, you exit and look for the next opportunity. So that would be one of the example I feel could justify the question answer to the question that you made. But again, it comes down to the time frame, and comes down to the objective that each investor or trader has for themselves. And based on all those, discipline is the most crucial one. And based on the objective, we have to place your stop loss and take profit. Which time frame should we consider RSI oversold or overbought? Again, time frame comes down to what your objective is. If you're looking at a shorter term time frame, your RSI by default will be giving you a result of a shorter time frame. Let me show. I think most of the questions over here are will have the answers when I'm doing the live one. I hope everyone's able to see my screen. Let's look at the live chart. Let's look at S&P 500. Okay, let's go very quickly. I know I'm running short of time. I hope if all of you are okay, I will take another 15 minutes of your time. Coming to charts, this is how candlestick chart looks. Like I mentioned, each of this candle represents the time frame. So this month, the price has opened at roughly, let me put the crosshair. So it has opened at 5092 and currently is trading at 5167. Now let's assume, but by the end of this month, the price closes at 5300. Then you will see a green candle up till here. But let's assume the case the price does not go above this after today, and it probably closed down here below at 4000. Then you will see a red candle because your open price is higher than the closed price. the wicks will become your high and low. So that is very simple understanding. I'm just going to put a 1 second candlestick. Sorry, let's make it 5 seconds candlestick to understand how the candlesticks are forming. This is for people who are just new. Let me change. Yeah, this is 5 seconds. So you can see this particular candle has a very long tail. It opened and closed at the same price. So hence you see a long tail only. Now, every 5 seconds, you can see a new candle is forming. Okay, this opened here, closes here, not yet closed, and it has closed. Now the next candle opened here and it's gone up and it closes higher. So now this candle is green. So now what you saw on a 5 minute time frame is the same thing that you would see on a monthly time frame, right? Now each month represents at the beginning of the month where did it open, and by the end of the month where did it close. Similar to 5 seconds, at the beginning of first second where did it open, and at the end of 5 seconds where did it close. Now all of these candles have a significance to it. Now if I go to my line chart, right, now head and shoulders is what we were discussing. This was the reverse head and shoulder, but there was also another head and shoulder that I did not mention on the demonstration, which is here. We see the price pretty much rallying up. Then we see a drop. Again, prices go up, a drop here, prices go back up, and then you see a bigger drop happening lower below over here. Now, this again, support resistance. If we add your, let's say, neckline, there's my neckline. Neckline breaks, that means we can expect the prices to move lower. Similarly, we had another head and shoulders, which is reverse. So the prices dropped, rallied up, made a lower low, rallied back up, made a shoulder, and then moved back up. Now, if I just turn this into a candlestick, this is how it would look. Let's say if I probably make it into a daily chart, which will give us a little more clarity of how the price action would have worked out. Let me just close this and keep this one open. Done. So now you can see this head and shoulder pattern. Now, if we were looking at a candlestick chart, it would have been very difficult to identify this head and shoulder. But because we looked at a line chart, it became more easier, especially when I'm looking at a larger time frame. Now, does the same pattern appear in shorter time frame? Yes. Let's look at a couple of smaller charts. Now, let's try and identify there's a head and shoulder here very quickly. If I make this 30 minutes, it's more easier to see. Now, this is something that has happened on 19th of March, right? This is pretty much from last afternoon till now. Let's look at how this one worked. Market drops, goes back up, made a bigger drop, goes back up, made another shoulder. Now, in this case, here's your trading opportunity. This is a 30-minute time frame. Again, coming back to the objective, because I'm looking at a 30-minute time frame. Let me draw the trend line. The neckline. Okay, now we understand our shoulder is here. I can change this into a candle, much more easier to see. Uh, line chart is much more easier to see. Candlesticks gives you more details. Now let's say this particular candle closed above the neckline, so that gives me a signal for me to enter. Let's take this trade as an example. Let's say I bought once this candle closed above, and my next candle opened also above the neckline. Now this is my entry point. Take profit, like I mentioned, will be the height or the length of the neck from the neck to the head. So in this case, let's say this would be my take profit roughly around here. Assuming I bought 10 units or let's say 5 units. So I'm buying 5 units of my head and shoulder pattern. Sorry. Yeah. So about the neckline. Now, in terms of stop loss, I had mentioned that we will be keeping it 1:2 risk reward. So if you're, let's say we are looking to make about $100, your stop loss technically should be at least minimum $50. That is 50% of the take profit. Now let me go back to the line chart. If you see as a pattern over here, your stop loss is below the shoulder. So that gives you a much more good enough room to keep your stop loss. So on a head and shoulder, it becomes very easy to place a stop loss. It's always better to place a stop loss right below the shoulder. And your take profit is, of course, the length of this entire move over here, which is about $17 down. Let's say 17, about 0.4%. If I take it on percentage wise, if I take it dollar wise, it would be somewhere roughly here. So my take profit comes lower. Yeah. So I'm looking to make $100 gain with a stop loss of $50. Now, in terms of technicals, in terms of understanding your entry points, in terms of keeping your stop losses, everything becomes very easy for you to look, identify, manage, and execute. Right? There is no complexity when it comes to technical analysis. It's very simple as long as everyone follows the rules. Now, in the case where, let's say, I'm confident that this prices will go up and I do not keep my stop loss, and then because I'm looking at a 30-minute time frame, in 30-minute time frame, the prices are sensitive to every news that comes out. Now, let's assume there was a fake news that came out which shook the entire market. What you would see happen is the price eventually, let's say after you entered, drop back down, right? Now let's say this news that came out wasn't fake, and now it is creating more negativity in the market, and the prices continue to drop. Now what happens is a trade that could have made $100 for us now is making a loss of more than $300 because there is no discipline of stop loss. But let's assume that we had a stop loss and the price dropped $50 and you're out of the trade. Now 1:2 risk reward ratio is ideal. 1:3 would be even better. 1:2 is keeps your discipline in place. Let's say you lose 50% of your trades and you make on your 50% of your other opportunities make you money. Now, if your stop loss on every trade is $50, you have lost $250, and you would have made, let's say, $100 profit on the other five trades. So you're making $500 profit there. So technically, your risk reward eventually will help you secure your overall portfolio when you're doing short term trades. So always diversify, always identify for more opportunities. And like I said, every technical tool that you use, please do use it in conjunction with other indicators. Now, talking about other indicators, let's just quickly. Now we've identified head and shoulders at this price. So I'll just leave the head and shoulder as it is. So it's easy for us to, let me just close this particular line. Okay, now our head and shoulder is there. Now let's add our two other indicators that we learned. One is RSI. Okay, and the other one is ATR. So I'm just going to put both of them together. Or let's just do it one by one, otherwise it will get too congested. Okay, RSI. So let's quickly look at RSI. What happened when the head and shoulder had formed? It shows that the price was oversold, right? And once the breakout happened, the price is overbought. Now, in this case, generally there is a divergence. So technically, head and shoulder is showing your buy signal, whereas your RSI is showing where it is overbought. So in this case, you could possibly avoid the particular trade. Now, let's assume you did go along with the head and shoulder in conjunction with a few other indicators. Now, you can use your ATR. Now, ATR, again, if you look at it, it shows SPX on a 30 minutes at this point in time. moves roughly on an average. If you look at it, it moves between, as of today, it is moving about $4. Let's say as of this particular point in time, it moves about $8. Now $8 move on SPX. So now we know that if the move once I enter, we can expect every 30 minutes SPX to move about $8. If I'm taking a trade, I can use, let's say I take a trade of 10 units. Now I know if it goes against me by $8, which is $80, I exit, right? And if the trade goes in my favor by 160, double of your ATR, I exit. My entry point would be at the breakout of the shoulder. Let me zoom this in over here. Sorry, breakout of the neck. Now, when I used my stop loss, I did not use ATR. Still, the price was way below the shoulder. So now using it visually or using statistics to keep your stop loss and take profit based on the price action that has happened earlier is much more relevant and crucial, because you are not keeping a stop loss too far away. At the same time, you're not keeping a stop loss too close by. You're keeping it in based on previous movement that has happened and what ATR is showing on the previous average movement over here. So now ATR helps you with a lot of things. Let's look at any other products that you want me to look at. I can do one live while we are talking. Someone's asked me, how did you come to $7? Can you please just ask me that question in regards to what the $7 was? Which time frame should we consider using RSI or overbought or oversold? Like I mentioned, whenever you're using RSI, let's say I'm looking at RSI for SPX. RSI on SPX. I'm just going to close all the others so it's more easier. Okay, now I'm looking at a 30-minute time frame and I'm going to add RSI. Okay, now I'm looking at a 30-minute time frame, right? Now, as per RSI, overbought is about 70%, oversold is below 30%. Now, let's use our support and resistance lines. We see resistance here, and we see supports at these price levels over here. Now we have identified a range on 30 minutes chart. Now the range is between these 2 points very clearly. Now you see the price is reversing. Now when the price is reversing, let's look at what RSI is telling me. So RSI actually is showing me that the price is overbought and hence we can expect the prices to come down, and vice versa. Whenever the price has come down, over here you see the price has been oversold. So hence you can look at taking a buy, and when it goes back to overbought region, although it did not go to your resistance, you can look at exiting. Now let's say I change my time frame to a 4-hour time frame. Now my RSI changes in accordance to what could happen on a 4-hour time frame, right? We have a similar move, but you have lesser entries and exits compared to what you had on a 30-minute time frame. Now, 30-minute time frame, the same channel, I think we get multiple entries if you're going with the RSI, right? But when you look at a 4-hour time frame, it gives you limited entries on the same time frame. So now it just comes down to fine tuning what time frame works for you based on your objective. How many dollars are you looking to make in a day? How much percentage are you looking at in a month, in a year? So all of these are very, very crucial factors that we need to consider before taking any trade or investments. So what I would recommend is, now what we've learned over here is basics, very foundational in terms of it is a good foundation to understand, to implement, to identify. Since you'll have got your demo accounts, I would I would recommend practicing identifying your support and resistance initially, even without using RSI or ATR. Just look at identifying support, resistance, trend lines. Now, looking at SPX, we have a very clear trend line over here. Again, if you use your line chart, it becomes more easier. This is my trend line here. You can draw a trend line even on the higher end. Right now, that is my resistance point. So now I understand this is a particular channel that SPX is moving in. Now, if I have to add RSI to this, let's look at what has RSI shown every time it has come down to support. So every time it came down to support, you see the prices was oversold. Again, you see it's come down back towards the support. You see the RSI is oversold. So if your support line and the RSI both are giving you an indication of a support, this is the point that you would look at entering, right? Again, now this is a point where RSI is showing me oversold, but my channel is not yet showing, or my support line is not showing me a signal because it is still way higher. There's a lot more room for it to come down. Hence, this is a trade I would avoid taking. So comes down to fine tuning which time frame works best for what objective that you have, and it comes down to also evaluating what kind of returns are you looking to make. If your risk reward of 50 to 100 $50 risk and $100 take profit is what works best for you, or if you are someone who would want to take a higher risk, you would probably look at increasing your number of units by using the margin but still keeping a stop loss, let's say a $10,000 account, but you would not mind taking a risk of $100 on every trade to potentially make 200 to $300. So ultimately comes down to these parameters, nitty gritties of planning it well. And this is where we would sit with each one of you all individually, make you understand how the markets are, which products moves, how many dollars, what are the strategies that you could implement, what are the plannings that you need to have on your overall portfolio. You can have a mixture of short term as well as long term. You can have a mixture of long term, and on the same particular instruments you can still take advantage of the shorter term moves on a certain percentage basis. Now, the complexity of planning this is quite wide, because it is each investor and trader is different with a different objective. What I would recommend is, please come visit us, sit with each of our advisors, understand more, learn more, and then it will be more easier for you all to understand, to take it further. I hope this session was informative. I said I'll take 15 minutes. I've gone past 15 minutes. I am sorry for those of you I could not answer all your questions, but I am available at any point in time. Please get in touch with your relationship manager. If you want to do one-on-one session, we can do one-on-one with more conversation where both of us can sit together and go through it one by one, and also get into a more advanced series of technical analysis where we can implement Fibonacci, Ichimoku, and few other indicators. Again, not to make it complex, just to break it down, to get much more signals before you enter any opportunity that is there in the market. Thank you all again so much for your patience and for bearing with me. I hope this session was informative. Please give me your valuable feedback. Your feedback is always accepted by me for me to improve. If you have any topics, any subjects, anything that you want to reach out and tell me, please feel free to write a feedback before you leave. We have one more session again tomorrow. I hope this has been exciting, and look forward to seeing you all again tomorrow. And good evening. Thank you again so much.